before I start, I just want to say to everybody that one piece of housekeeping for tonight is if you hear the fire alarm go off, that is not a practice run, that's a real thing. There's no fire alarm set for tonight. I think you all had clear instructions in your email when you RSVP'd as to what to do if the fire alarm goes off, so I'm not going to run through that now in the interest of time. But we'd like to kickstart tonight's session with Deepak. Could you tell me your thoughts on Scott O'Malley, the CEO of ISDA, International Swaps and Derivatives Association's comment that derivatives play a critical role in the efficient performance of markets and the mobilisation of capital? Do you agree or disagree with this statement, and for what reasons?
So Scott is a client, so I completely agree. And I genuinely do agree, even if ISDA weren't a client. So derivatives are really funny things because they are the kind of instruments that are hidden in plain sight in a way, and it's one of those things that when you know what they are, and you kind of work with them day to day, you kind of see them, you see how they're used in the day-to-day economy. So maybe just to give some examples of the useful purposes that they serve. So the real obvious one, when I go into, to much to my kids' embarrassment, I have to go into school and explain what I do. And so the example I always give is fixed rate mortgages. Like most people will have a mortgage, and a number of those of you who do will have opted for the safe bet to fix your mortgage. How do you do that? Through interest rate swaps, and so that allows kind of a good proportion of the country to make sure that they are managing their interest rate exposure. And it always makes me laugh, particularly in the high interest rate environment that we've been in, when you turn on Radio 4 in the morning and they're talking about the swap rates, which is what basically leads you to figure out whether or not interest rates are likely to go down or up, which then feeds into the direction of travel for fixed rate mortgages. So that's one example. Another one that we kind of neglect, but again it's really apparent in our day-to-day business is airlines. So airlines use derivatives to hedge their oil price exposure. And so again, when I go into school and explain this to my kids, I say, well, would you think it would be? Do you think it's appropriate if you pay £100 for an airline ticket, and then just when you get onto the plane, the airline says, well, the oil price has gone up since you booked your ticket, so it's now £300, and they're like outraged, a bunch of 10-year-olds outraged at someone doing that. And the reason they don't do that necessarily is because they've locked in the futures price on airline oil or jet oil. And then we're seeing a lot in the world of interest rate exposure management at the moment. Obviously high interest rates now, and so a number of companies are using interest rate derivatives to hedge their exposures. Currency risk is another one that, again, hidden in plain sight, but the amount of currency hedging that goes on, even Linklaters, as a law firm, we hedge our currency exposure because we are a UK law firm, so our kind of sterling denominated, but we have offices around the world, which means that we have income and liabilities that are denominated in other currencies, and so we use derivatives just to manage that exposure. So what I think they are pervasive. I do think they are a critical tool in the financial markets. They have obviously had a bit of bad press, so you have to use them sensibly and wisely. And I do think that there's been a much more of a greater push, both from a regulatory perspective and just kind of market sensitivities and kind of consumer duties to make sure that people are using them sensibly. So, long way of saying, yes, I agree, they're quite an important tool.
Fantastic. Thank you very much, Deepak. And so thank you for giving us all an overview of the utilitarian aspect of derivatives and how they serve us and what purpose they serve. And now I'd like to turn to Ed, who is very knowledgeable about how far back derivatives go, and we're going to delve right back into time to a comment that Ed has made on one of his very well-known podcasts about derivatives going all the way back to Mesopotamia. Could you please elaborate on this?
Thank you very much. It's lovely to be here. I also am an alumni of University of Law, although it was called the College of Law when I attended. I did my LPC in 95, 96 in Store Street, so lovely to be here. I have indeed said that derivatives go all the way back to ancient Mesopotamia, and this came up because I've written many books on derivatives, credit derivatives, equity derivatives, commodity derivatives. And my father is a historian, and he's written many books on Philip II and the Spanish Armada and similar. And after I published one of my books, I received an email from a lawyer at White and Case, and he was a Spanish lawyer. He said, "This Christmas I've read your book on credit derivatives, and I've read your father's book, Global Crisis." And I called up my dad. And I said, "I bet this is probably the only person in the world who's read both books." And we sort of turned to the history of derivatives, and there has been some stuff written about it before. Sometimes people have said, "Oh, well, derivatives goes back thousands of years because somebody had done something that's vaguely similar to buying up olives for a fixed price and at a future date." And I looked at this and think, well, it's not really derivatives at all which was being explained. But my dad was at that time also teaching a course on ancient civilizations. And so we looked up some of the sources, and we got back to ancient Mesopotamia, 2,000 years BC, and we discussed, what's a definition of a derivative. So if you think of the modern definition that we would use of it's a financial instrument that derives its value from an underlying asset, such as Deepak said, could be jet fuel, could be commodities, equities, credit, or similar. It's entered into by the parties for a reason. But we drill into that financial instrument, and the key thing is these swaps, options, forwards, structured notes are assignable contracts. So to say were there derivatives thousands of years ago, we went and looked at the ancient Mesopotamia civilization, and there was an emperor called Hammurabi, and they had commodities forwards. And what would happen was farmers would, at the start of the harvest, they would sell their crop in advance to an exchange for an agreed price at a future date. So you've got a contract to sell an underlying asset, commodities, grain, agreed price, future date. That wasn't enough for me to say that's a derivative. What did make it a derivative is these contracts were assignable. So these contracts were traded at the exchange. And Deepak also mentioned regulation. They had great regulation. You broke the rules, you were executed. So it was a very, very strong regulatory environment as well, which accompanied that. We then see this coming up in ancient Rome to some extent. We looked at the market on indulgences as well. We thought there were some similarities for that. Where we really did see it was there was a futures market in tulips in the Netherlands in the 17th century. That came back into the press with crypto, where people were saying, well, is there an analogy with these tulips that went out to equivalent of millions in modern day money for tulip bulbs, and then the bottom fell out the market and it never came back. And then we've saw them in the city. So at the Royal Exchange in the 17th century, we were seeing the trading of equity derivatives, so forwards and options on the new underlying stocks. The South Sea bubble happened about that time. Equity derivatives were banned in the 18th century for some time. And then we looked at the growth of derivatives in the Americas, again, driven by commodities in the 20th century. So we put this into a video 10 years ago, and we did a video we called History of Derivatives, Ancient Mesopotamia to Trading Places. And the reason we chose Trading Places, it's a movie from 1984, Eddie Murphy, Dan Aykroyd. If you haven't seen it, it's fantastic, and it sort of centers around a futures exchange in Chicago. The reason we chose that is it's the year before ISDA's created, which is 1985. It's a lovely cut-off point as well. So whenever we talk about these modern instruments, I think where this goes very nicely into what Deepak was saying is the derivatives were done for an underlying reason, which was farmers trying to lock in the price of their harvest at the start of the season when they've got their costs. Yes, the price of grain might go up, but it might go down as well. And that's exactly what's the same as happening with the airlines locking in their jet fuel price, Linklaters locking in their foreign exchange price, and similar. So we have similar underlying reasons across the whole 4,000 years, albeit that our documentation is stronger, but our regulation is weaker because there's no execution for getting it wrong.
Thank you, Ed, for that answer, and I hope that helps the audience to understand why we find derivatives quite so exciting as we do, because they're not just a kind of dry subject, they are a really living subject, and they go back so far through time. And it's through things like your films and your books that you've managed to spread your knowledge and understanding. So my question to you next is about your experiences as a writer, writing books. Which ones have been the most popular?
Well, my sort of path in writing, I was asked to do an article for PLC about 2002 or so, and I wrote this article, and then I was invited by Globe if I'd like to edit the new book of practical derivatives that they were doing, and I felt I was a bit too junior at that stage to be able to do that. So I ended up writing 3 chapters for practical derivatives, and at the end of that, I really thought I'd love to write a book on credit derivatives. At the time, I was a single chap. I was living at home, and where do you find the time to do it? So I used to just work every weekend, and the challenges were, I've spoken to lots of people about how they write, and some people say, well, I'm going to set myself the whole morning I'm going to write. I used to set myself a word count and think if it takes me till the evening, I'll work all day. If I manage to finish at my lunchtime, I'll do that. And I used to do 2,000 words every Saturday, every Sunday, and eventually that got up to about 180,000 words in the end. And I published Credit Derivatives, published it in 2007. I then edited Equity Derivatives as a book. I got different authors from different law firms to do that. The next time I did Commodity derivatives, and I got associates from my own law firm to do that, and then after that I did a second edition of Credit Derivatives several years later, 2017, and I took over the editing of Practical Derivatives. We're now on our 4th edition, which I do with March and Perzanovsky, and it's a really good book across lots of different asset classes, and there's very different challenges for each one. If you're writing your own book, you've got to be very disciplined. You've got to work through it relentlessly. My next thing was thinking, well, it'd be easy to edit a book, but you find that you reach out to people in different jurisdictions. I wasn't so structured in what I asked for up front, and so you get very different chapters come in. Had to do a lot of work to edit that to make it all work.
Interesting.
And then I thought, well, this will be easy. I'm a partner now. I'll get all my associates to do chapters, and they'll be so in fear they'll all deliver their chapters at the deadline. And nobody did. Everybody's talking to each other, and gradually you get people over the line. And it is that real challenge with books. My publisher tells me that the amount of falsehoods that come through when lawyers do not hit their deadlines. She told me that one day she had on a book there was 15 chapters, and 4 lawyers who were contributing chapters claimed that their computer had completely crashed at the weekend, and they couldn't deliver their chapter. So when that actually did happen to me, I actually just sat down and rewrote it. I didn't dare to claim it.
So just that you've covered a lot of my questions about your work as an author and an editor. The only 2 remaining questions that I had is which book sold the most copies, and which one was the most criticised and why? Well,
actually, it's the same book. Actually, my Credit Derivatives book in 2007. So I published this in May 2007. And I covered all of the financial products that were being done. I published it before the financial crisis. I was very critical of a product in there that was called CPDOs. And CPDOs were a form of credit derivative where you just, every time, they would have massive leverage in them, and so 17 times the principal would be leveraged. Every time one of these things closed out, you just increase the leverage. And I compared in my book, I said, this is a bit like going to a casino and gambling on red and black, and every time you lose, you double your bet. And one of the banks that had a desk doing this were on the verge of complaining about me to my law firm that I'd written this, and then their deal started to go bust. And then they all got fired, and then the financial crisis happened. So that was quite a bit of a lesson in be careful about what you write about. The book did very well, and then I redid it. There's a lot of changes over the coming years, and I did a new version of that in 2017 as a new credit derivatives book, and it's continued to do very well. It doesn't. You do get royalties, but for the hours spent, it's pennies. It's all within the reward of writing something.
So it's a love of something other than.
I think yes, but I think you do. I do think, and I would recommend anybody here, if you're interested in writing, try writing articles. It's much easier now because you can self-publish articles on LinkedIn and similar. But you do become, I think, a much better lawyer. You do become a much better at legal writing as well. It's a good discipline. It's almost therapeutic to do it. And I did say to my publisher, I had a number of young children suddenly, I said, I'm going to have to retire for 5 or 6 years from this, but I will come back and do some more writing later on.
Thank you, Ed. So now, thank you very much for covering the distant past realms of derivatives and your work as an author. And moving over to Nick now, we're going to look at the future. And can you tell us whether there are any changes on the horizon that you believe market participants in this space need to be aware of?
Yeah, definitely. I think we've now gotten a good understanding of some of the history, and part of what came through in Ed's answers is that it's been a dynamic area and a dynamic asset class, and that continues. I think have been and continue to be a number of changing dynamics really in every area. So for one, it's a financial instrument that that derives its value from an underlying thing. So the underlying thing, the asset class, with the rise of cryptocurrency, that in and of itself is obviously very dynamic. ISDA, which was alluded to, it's a trade group essentially, but they have worked very hard and done an excellent job of creating standardized documentation, and for different asset classes of derivatives, standardized definitions. So parties can always change them however they want, but everyone's basically at least starting from the same place. And very recently, they released the first edition of the digital asset definitions. The nature of crypto markets, from how prices are determined to the fact that they trade 24/7, is markedly different from anything that anyone was used to. And while the definitions did a great job of taking all that into account, there's still a lot of evolution and battle testing that needs to get done in that space. Obviously, after the financial crisis, there was a host of regulatory changes, the laws that were passed, rules that were set to be made. A lot of those now, the U.S. has been a bit behind, but for the most part, most of those rules now have officially been implemented. But there continues to be a wide range of regulatory changes on the horizon, again, going to different things like asset classes, more macro level changes, but that have an impact on the derivative space, like bank regulatory requirements and Basel III, those types of things, again, play a huge role, and we're continuing to see those evolve. The products themselves, right? Those are constantly changing based on the environment that we're in, both the market factors and the regulatory factors. So, one trade or class of trades that has gotten a lot more popular over the past couple of years, as banks are required to hold more capital on their balance sheet, is finding ways to transfer risk off of that balance sheet through the use of derivatives. And it can be done in a number of different ways, but what it essentially does is if a bank has product one, let's say it's a $10 liability, and because of the nature of that liability, they need to hold $3 worth of capital. So $3 they need to just keep in a separate account because they have this $10 thing. Using derivatives, they can effectively transform that $10 thing that would have required them to hold $3 worth of capital into a thing that only requires them to hold $1.50, for instance. And so then they now have an extra $1.50 that they can put into the market, whether it's loans or whatever other bank activities they want to do. So again, in the nature of the products we're seeing, that's continuing to evolve. And last, and it's I think the least fun to talk about, although all the technological developments have certainly made it more interesting, or at least more trendy to discuss, is operational arrangements. Derivatives up until very recently were very often just bilateral, bank and hedge fund, or farmer and central clearing agency buying a future. There's been a move to getting more things cleared, which means having a central counterparty, moving away from the bilateral arrangements. There's also been a huge increase across the world in terms of margin, which is essentially security collateral that you need to post when you theoretically would owe based on the current market value. And so this increase in margin creates a lot of different operational constraints and considerations, and one of the big areas I think that we're probably all seeing, and ISDA amongst others is focused on, is trying to find ways to increase operational efficiency, because there's a lot of instances where essentially if a hedge fund has derivative trades with, let's just say, 10 different parties, they essentially have 10 separate pots of gold with 10 separate collections of collateral. And they might be doing really well on thing 1, not so much on thing 10. So they need to post more margin on thing 10, but the only value that they could readily transfer is some of that value from deal number 1 that's doing good. How quickly can they get that over? Things like that. So the operational aspects, I think, are also, again, a huge space.
Thank you, Nick. I'm now going to ask a few questions from our speakers that are a bit more personal and moving away from the industry sector. So, Nick, can you share with the audience the benefits of being a very young derivatives partner, and what are the challenges of that role?
Yeah, definitely. I feel like I might be getting set up a little bit with that question as the junior would here. But look, I think for one, every challenge is an opportunity. So I'm licensed to practice in the U.S. I graduated undergrad in 2009, which was a terrible time. I went straight through to law school, did very well, but it was still a terrible time for jobs. So I graduated law school in 2012. Thankfully, despite not going kind of the usual summer associate route, the market rebounded, so very quickly I was able to get a job at a big law firm doing derivatives. And so that was obviously, though, a challenge. Nonetheless, I've essentially gotten to see the regulatory transformation of the entire space in which I work over the first 12 years of my career. And that's amazing, because literally almost all of the rules that now apply to all these different types of transactions and asset classes and product types have come online or continue to come online since I started practicing. And so even as a junior, when I didn't necessarily know what it meant, I was working on maybe just the operational aspect and just figuring out how to get it from here to there. And then obviously as my career continued, I had the chance to get more intimately acquainted with all of those details. But so I think, like I said, every challenge is an opportunity. I think, again, that's also just benefited me in that I've gotten kind of a condensed learning course, amassing the entirety of knowledge, or not entirety, obviously there's always more to learn, but amassing the amount of knowledge that I have a lot of times would take much longer, because every issue doesn't necessarily come up all the time. But if all the rules are new, then literally every issue will be coming up. And so that's been great. I think one thing that certainly helps, I think, me is just I was the first generation to grow up with my own laptop, and so I have a different relationship with technology, and a different understanding of what it can do and how it can help. And particularly in this space where you're dealing with a lot of documents, you're dealing with a lot of information, you're dealing with a lot of technical stuff, even just trying to figure out, different trader calculations sometimes, like having the ability to know how to run some basic formulas in Excel, or, start to use macros with some basic VBA coding to help start automating documents. I think that, appreciation and willingness to push the envelope in terms of tech and how that can help, with the lawyerly duties is certainly a benefit.
Great, thank you, Nick. Any challenges?
All the usual. If you have the choice of going to the person who literally wrote the book on derivatives, or this upstart, I wouldn't fault you for going to the man that wrote the book. Building up the reputation, and that just comes, first and foremost, obviously, with the clients. The people you're dealing with directly are in the best position to know your capabilities, know your strengths, kind of starting there, and then, just doing what you can to build out, whether that's networking and, getting out to the events, trying to find writing opportunities and things like that. But, that's certainly a challenge, but to my earlier point, also a great opportunity.
Great, thank you, Nick. And now, Deepak, I was actually going to ask you a personal question about your career, but before I go there, I might leapfrog to one of the questions that we were going to address at the end, just because Nick raised the issue of technology. No, you just raised the issue of technology and how your assimilation of technology and where that places you within your skill set as a lawyer. And Deepak, you were going to actually discuss what role can technology play in the evolution of the derivatives market. And I just thought, on the back of Nick's question, maybe we should jump on to that.
Yeah, and I'll say one thing actually. It's quite funny. Just when I was interviewing as a trainee before you did, one of the key distinguishing features between law firms is whether trainees had their own computer. Forget laptop. It was sometimes you had to share a computer. So things have moved on. So then when it comes to the use of technology in the derivatives market nowadays, one of the great things about this market is, as you were saying, Nick, there's a lot of volume, there's a lot of standardization, and it's a really kind of cutting edge market from the 17th, 18th century onwards. And so there's a real role for technology. So what we are seeing, and I have a particular interest in it, is actually how can you move the way in which lawyers perform their roles forward. So one of the things that we focus on is we've built a platform here at Linklaters actually that helps negotiate ISDA documentation. So it allows you to automate documents. So what we find is what associates normally spend an hour producing from a precedent, actually they can do it within 10 minutes. And then you are able to negotiate documents online. So you're capturing what I'm now learning is the role of a lawyer is not necessarily to argue forever to get the best deal, and it sounds a bit crazy, but in the olden days you'd see people spend hours negotiating about reasonable efforts versus best efforts and stuff like that. When it's not, as my daughter would say, it's not that deep, and so what comes out of it is actually what is much more valuable to large organisations is the data that is within the contract. So that's one thing I've learned, and so now actually when we're producing contracts, we have a mind to the data that is within contracts. And so how can you actually produce the contracts in such a way that the data is much more readily transferable into other systems that will use those contractual terms. So that's led to a different way of drafting even, actually. So Nick, you mentioned, for example, the digital asset derivatives definitions, which we put together. We did that with codification in mind. So it's like probably no other contract that you've read, because it is written with if da-da-da-da, then da-da-da. And so that means that it's much more readily convertible into code. You could probably do all of the coding as well, but but it does go to show that technology and law need to work hand in hand, and I do think the role of a lawyer has evolved, because you need to see the kind of where you sit in the universe, and it's not, as I say, all about negotiating really micro points. It's about moving those contractual terms so that they can actually be used in practice.
Lovely, thank you, Deepak. And now to revert to the more personal questions. So you yourself are currently a partner at Linklaters. Do you mind if I ask, did you come here as a trainee and do the whole Linklaters pathway up?
So I'll go back in time a bit. So I went to law school here, and I studied English law and French law. I really just wanted to go and live in Paris for a while, to be honest. I had no other interest in French law. But when I was there, I thought, actually, I'm not sure if I want to be a lawyer. I'm going to go quite into a lot of detail, so cut me off. So then I was like, actually, what I'll do is I'll go and work in a bank. So I got an internship at JP Morgan, and I had to interview I had seven interviews to actually get into their internship program. And then they looked at my CV and they said, this guy's studying law, so what we're going to do is we're going to put him in the basement, and we're going to get him to check day count fractions in bond terms and conditions for 10 weeks. And it was one of those kind of programs where they take you out because they want to woo you into the firm. And so I'm not very good at holding my alcohol. And so after about 5 weeks, we had one of these big things. And I said that I had a few too many, and basically said, what a waste, right? You've 7 interviews. I'm checking day count fractions. It's ridiculous. So that was on a Thursday night. Friday morning, I went into work slightly hungover. Got a phone call from HR, absolutely petrified. So I went up, and they said, well, we took on board your feedback, and you're absolutely right. And so they moved me into the equity derivatives business. So there's a long way of saying this is how I got into derivatives, because I got drunk one night. And so I then decided, actually, I do want to be a lawyer. So then I interviewed here. Got rejected. It was like my worst ever interview. So anyway, long story short, I went to Clifford Chance, where I had quite a nice time, but my wife was a trainee here, and she said, you would like it here. So I came for what I thought was a coffee, but apparently coffee doesn't mean coffee. Coffee is actually an interview. And so anyway, I joined on qualification and then stayed. So I've been here, it will be 24 years next month. So made partner in 2007. Worst time, apart from publication of your book, it was the worst time because it was the onset of the financial crisis. But it was really interesting in terms of, and jumping around a little bit in terms of, how the life of a lawyer evolves from whatever it was, late 90s through to now. I touched on trainees didn't have their own computers. The other one was, I remember negotiating, being sent out overseas to negotiate a derivative to finance a submarine, which was the most kind of bizarre use of a derivative. And I said, well, I'm in this foreign country. Can I please have a BlackBerry? Because otherwise I'm completely incommunicado. Most of you won't even remember what BlackBerry is, but completely incommunicado. And they said, no, because you're too junior to have a BlackBerry. And so I was like, this is crazy. So just to say that the world has changed so much, because now, not only do you have the iPhone, it's with you all the time, and you are kind of completely and utterly contactable. So that's been the kind of story into Linklaters.
So you had to climb the ladder through being a trainee to an associate to a senior associate to a partner. What are your particular favourite aspects of being a partner? How has it changed your day-to-day work in terms of what you actually have to do? Do you spend most of your time organising the associates and the senior associates? Do you miss doing any of the groundwork, or do you enjoy it more orchestrating the orchestra as well?
So misconception is that we play golf all the time. That doesn't happen, actually. I think I've certainly worked harder as a partner than ever I worked before. It is very different, and it depends on the day of the week, actually, if I'm honest, as to whether I prefer life as a partner or as it was as an associate. But if on balance, I really enjoy it, actually, because what do you get to do? You get not only to do work that is interesting, but you then even though this is kind of a large law firm, you're kind of running a mini business within the law firm. So I really like the entrepreneurial aspect of being a kind of a lawyer who is a businessman in a way, because you have to go and obviously generate work, you have to do the work, you also have to run a team, and like law is a people business, right? It really is quite simple, right? You've got to be a client pleaser, and you've got to be able to have a team that's motivated and enthused and interested in what they do, and if you can work those dynamics well and hopefully charge for it, then actually you've got the makings of a good business. So I really enjoy those aspects. They do bring more stress because, you know, I'm, as most lawyers are, like, immensely paranoid if the phone doesn't ring with an instruction on every day. So that kind of insecurity does kind of come through. You have a lot more to deal with in terms of, you know, the problems that individuals that you work with suffer, because obviously the more people you come across, the kind of broader range of issues that come up as well. So that kind of requires you to kind of break into skill sets that you might not otherwise have had. So yeah, all in all, I kind of really enjoy it. But there are also those good days, sounds terrible, when the associate you're working with is called in sick, so you have to do all of the work, and then so you clear your diary and you do it, and you think, oh yeah, that's really good as well. So it's just finding the right balance between kind of doing the kind of managementy piece, and also just doing effectively what we're supposed to be good at, which is running the files. So and then the other bit I really like about it is you're able to take what you're interested in and just go for it. So for example, I really like training and mentoring and things like that. So I deliberately put myself forward for running a new partner program, and it's really good. You take people who are probably the happiest in their career because they've just been promoted, and then you kind of download them. Yeah, this is what can happen if you do naughty things, and the SRA can get in touch with you and things like that. But it's really interesting to kind of grab people like that. And then
are you talking from experience?
No, multiple experiences.
Even in the US, I learned.
What's that?
The SRA can also come after U.S. lawyers.
They go everywhere. Yeah, so that tends to be the real downer chat when we talk about that one. But
at least it's not Hammurabi.
This is true. This is true. And then other ones are tech. Like I've already said, I really like tech, and so you're able to say, well, this is my interest. How can we further it for the firm? So I sit on the steering group for some of our client technology initiatives. So yeah, I quite like that. It's varied.
Thank you, Deepak. So moving on to you, Ed.
You're not young either, by the way.
No, definitely not.
So you've obviously done the role that Deepak is doing. And what are the differences between that role and becoming a global head, and presumably overseeing multiple departments in multiple jurisdictions? And what is unique about that role and different from being a partner? And what parts of that role do you particularly thrive on, find exciting, and which parts of it are the more challenging parts?
Well, actually, a lot of what Deepak said, it sounds like I was listening to myself almost. A lot of things that you find interesting about the law really chime with me. So I'm the global head of our practice at derivatives practice at Mayer Brown, and what does that mean? It means you need to have a very strong US practice, you need to have a very strong English practice here in London, you need to be able to cover the EU rules, you need to have some form of practice out in Asia as well. And I think the best way to explain that is as well is being able to follow clients through their global needs. So I'll take an example, Santander Bank, and a type of product that we do, which is synthetic securitization credit risk transfer products, which in spite of the name is actually very much a derivative-driven product. So we did the first of basically these are regulatory capital-driven trades. It's things that we used to see before the financial crisis that were done as synthetic CDOs. Now there are ways that the banks are able to save the amount of capital that they hold against large billions of dollars of loan portfolios using derivatives. So we did the first deal in Mexico for Santander back in 2018. We actually did the second one for them several years later, closing last year. We repeated that deal in Brazil. I just closed a similar deal in Chile. And as they moved this product, which we'd been working on in Europe, it's very, very popular, into the US, we were using our US lawyers are drafting all of the documentation for that. They're complying with the US regulatory rules. But the client is based here, and the client needs to save its regulatory capital in Europe. So we would be drafting these US documents to comply with European rules. I'd be writing these memorandums that would go to the regulator to say all of these rules have been complied with, this is how they're complied with, therefore the bank can save can save its capital. And so what I like about that chimes with what Deepak said. I really like that academic piece of being able to pull together different laws. It's very, very challenging. I love that entrepreneurial piece as well of getting to know the clients. You can't just sit there and wait for the work to come in. You've got to go out and you've got to build those relationships in multiple countries as well. So that, I think there's very, very few jobs in the world where you can be entrepreneurial and academic at the same time is what I like. It's usually one or the other. So to be able to pull that together, and then sometimes just to be, even when you sort of work from home for a day and you get to lunchtime, you think, well, I've been speaking to people in Mexico, in the US, and we do a lot of work in Turkey as well. And you think you're covering all of these different jurisdictions just from your desk is a real part of that I like, together with having a global team and working together to do that. When you mentioned that, the challenges of that is finding the right work. What's actually going to work with that global piece? And one of the things we've seen over the period is there are lots of it's a very expensive resource to have a global practice. And there are people coming in as alternative legal service providers. There's the accountants. There's alternative legal services providers. So things that would have been done at a law firm maybe 10, 15 years ago, even less, are now done by other people. They'll have low-cost centres and other jurisdictions, and you can't do that. So you're continually at this sort of rocket science, what sort of grey hair element in in private practice, and you can't ever think that you're going to be doing the stuff that is becoming commoditized. That's going to move elsewhere. You're not going to be economic doing that, and that is a constant challenge to keep that relevance. I'd say as a final thought, I know all of the derivatives partners in London very well because there's not very many of us. And whereas my colleagues in litigation at the firm will say that if you go to any client, they'll have one or two people who are doing litigation. You'll have hundreds of lawyers at law firms doing litigation. We're the other way around. There's very few people doing private practice derivatives, but you go in-house, it's the biggest area for having lawyers, which is great for relationships because the general counsels are often the derivatives people and other things. But it means that you've got a constant fight to stay relevant for your clients.
Thank you, Ed. And still on the topic of global, can we talk about what jurisdictions are relevant and key for derivatives and why? And has Brexit threatened English law as a governing law for derivatives? In fact, that last question was the subject of an entire session at A&O, I think last year. They did a whole 3 hours on this subject, but you've got 5 minutes.
Okay, well,
Thank you.
Well, there's two principal jurisdictions for derivatives, and that is English law and New York law. I think that about 90%, probably even much more than that, of derivatives law contracts are done under English law or New York law. So those are the most relevant jurisdictions, but counterparties for derivatives contracts will be located everywhere. And one of the big things for ISDA, the trading body, is we have netting opinions, collateral opinions. What happens when you close out these contracts? Something that we studied in detail and practiced in detail after Lehman. So you're dealing with the insolvency jurisdictions of anywhere in the world. And so you do need to have those relationships with law firms everywhere. We've done 30 jurisdiction surveys in different countries of how to, what are the closeout mechanisms in those countries. So you must have the English and New York piece. And we, our belief is about 70% of legal spend generally in the world is in the United States. And New York law derivatives are a big piece. So you need to have that US piece. That's a very important piece. But English law is the piece that works, that everybody respects as well. So you'll find the contracts are under English law, and then you have the relevance of how does the insolvency work, how does the closeout, how does the netting work out in other jurisdictions, and then you overlay that the regulation as well. So in each jurisdiction, it can have its own regulatory element. So for the EU, we have EU regulation. For the UK, we have UK regulation. You have Dodd-Frank regulation in the US, and any jurisdiction at all, there's going to be some form of regulation as well. So that again makes that very relevant, the different laws. Moving on to the Brexit piece is interesting. We do an OTC derivatives conference in our Frankfurt office every year. We've done that for 10 years. 2016, unfortunately for me, the OTC derivatives conference was 2 days after the Brexit vote, and our German partners bullied me into speaking to an audience about this size about the effect of Brexit, and we had drinks afterwards, and our offices were on the 30th floor of this tower, and our German clients were pointing out where I might like to live when we all moved to Frankfurt, and they were saying you'd love this suburb over here on the edge of Frankfurt. But it hasn't happened. You come back every year, and I say, well, has everybody moved out to Frankfurt? And they haven't. And ISDA had a period of, I think, being rather forced to do this, to say, well, we'll set up the English law ISDA master agreement. We will do some local law, some EU law equivalents. They did not choose German law because there's a system of what's called protocols, which just does not work under German law. So they picked French law and Irish law as the two forms of ISDA master agreement. The Irish law one, if you redline it against the English law one, it's almost identical. There's a different paragraph for insolvency. The French one is quite different. There's a real push to push this French law one from some French lawyers who I know well because I spent some time at Gide in Paris. But I keep asking clients, and I'm interested if Deepak's found similar. I keep asking clients, have you ever used one of these? And I haven't found a case of a cross-border example of, say, a French counterparty entering into a derivatives contract with a Spanish counterparty and using the French law version. Or even more so, an Italian counterparty with a German counterparty and they're choosing the French law version. I just haven't seen that happen. So whereas what we're seeing is we're seeing quite a lot of individuals from our financial institution clients moving to Paris in the main. We haven't really seen it happen in Germany, but we're not seeing a shift to using EU laws instead of English law. Deepak, I'd be interested if you've seen something.
No, as soon as when you said cross-border, I was like, I'm with you. Like, no one's. I've seen a lot of French domestic use, so no, I agree with that. And the other one that's interesting, just topical at the moment, is the removal of banker bonus caps as well. Actually, because now we're starting to see some people who have moved out to Paris think about coming back. So there's a tension there around the size of presence that firms need to have kind of in the EU versus London.
I mean, the interesting one as well was there was a big discussion that clearing which was a big business in the UK, was going to move to the EU, and there was a push to move this to Frankfurt. And we always thought that if post-Brexit the EU had said, right, we are choosing Frankfurt, that is going to be our capital market centre, it would have been a real challenge to London. But it became quite fractious, and actually it was the French that blocked a lot of the clearing moving to Germany. So some of that's moving across, but even a year or two ago we thought, well, that's probably going to move to the EU, and that seems less likely. So with time, that pressure seems to be moving somewhat. Certainly for derivatives, not something that keeps us too busy outside of the main, doing some clearing agreements, but it's a big part for the derivatives industry of London.
It made me wonder whether I should refresh that French law degree that I got, and my wife, I did drive her a bit nuts, saying, "Okay, well, we've got to go and I'll requalify as a French lawyer." Obviously, I haven't, and I think it's exactly that. It has settled. It'd be interesting to see where things are in 5-10 years, but it's probably hasn't changed as much as I was expecting it to have changed when I woke up at 5 that morning on the referendum day.
Thank you, Deepak and Ed. And Deepak, moving to the next question now. Since the days of the 2008 financial crisis, and which was covered by the very popular film The Big Short, which dealt with this period, which one regulatory change over the past few years has had the biggest impact on your clients, and has that impact been positive or negative?
So if you do watch The Big Short, they talk about the ISDA agreement. I got very excited when that happened. More excited than Margot Robbie in a bath. But then in terms of the regulation, I think we've seen what happened with the financial crisis was there was a clear illustration of people not really knowing what was happening in the derivatives market. So regulators didn't know where the risk actually lay. And also we saw that there were actually some quite large exposures in terms of risks that people were running, and that risk wasn't adequately covered off. So we saw basically global regulation introduced. And what did that do? It did a few things. One was to effectively force people to report their derivatives transactions. So now, every time a transaction is entered into, it gets reported. The idea being, if the music stops, the regulators can pull the reports and figure out where the risk lies. Let's see if that can actually work, because there's quite a lot of data in there, but there's that piece. And then the other bit was around exposures. So I think, Nick, you touched on kind of mark-to-market exposures, which means that the value of a derivative can oscillate. So unlike with a loan, so if I lend someone £100, I know that my exposure to them is £100 plus possibly some interest. Whereas with a derivative, I could enter into a derivative with someone, and today, if the music stopped, I could owe them £100, but if tomorrow the values could move around, and actually it could be that they owe me £200. So that oscillating kind of valuation needs to be covered off. So what the regulators have effectively asked for is that you measure the exposure that you have on every day, and then you have collateral or margin that's posted to cover that exposure off. So that's resulted in a lot of paperwork. Lawyers kind of like paperwork, and it's resulted in a lot of assets being moved around as margin. And so in terms of that's been an enormous change. Now there's good and bad in the change. So one is in theory, it should be that it's a safer environment now. So if something does go wrong with a particular institution, it should be that the regulators know what the position is. It should be that actually if there's a termination, collateral or margin is usually covering off most of the exposures. So that's a good thing. Sometimes people say that the balance between good versus taking or imposing cost into the system, it hasn't been quite kind of struck correctly. And so now some people say, well, yeah, you've made it uber safe, but the problem is it's just too expensive to run our businesses. So that, again, the regulators are kind of having another look at that. But what it does mean is that this area is more complicated. And so, Ed, you were talking about, academic and the kind of entrepreneurial nature of being a lawyer. Actually, there's another bit that I quite like out of this, which is I really like doing transactional work, but also I need to be able to advise clients on the impact of the regulation. So it means that I'm now stretching the skill sets that I use day to day. So from a purely personal perspective, I quite like it.
Great, thank you, Deepak. So following on from that, we then obviously went into a pandemic, being another massive event impacting the market, and we saw a reverse direction to the kind of steps that were taken in reaction to the financial crisis, in that we went back towards low rates and a relaxed monetary policy, triggering rapid inflation and rising rates, and then back to rising rates as a result of that inflation. We're now seeing a return towards target inflation rates, although that's a bit of a back and forth ground. They're saying, yeah, it's going great, and then maybe not so great. So we're not quite sure, but we seem to be moving slowly out towards a better place. And so we're now we're seeing relatively rapid and unexpected changes. All these shifts, how did this impact on your clients' positions, exposures, and products? I always love listening to Deepak talking about products because he's really good at describing.
So I mean, look, there's a few things in all of that. So COVID was fascinating, actually. So one thing that happened was most people who had written contracts hadn't really anticipated things being shut during a pandemic. So that ranged from exchanges just out of the blue shutting, and so people had to then kind of figure out how their contracts reacted. It led to a lot of volatility, so the equity markets went crazy, and so we saw some equity funds who had kind of basically taken a bit of punt on the expected volatility of equities, saw this kind of black swan event appear, and the volatility went nuts, and they kind of went bust. And so then that led to a kind of range of terminations. And so when you're terminating an agreement, you kind of need to let the person who's defaulted know, and that is easier said than done during a pandemic, because you kind of open your contract and you said, okay, well, if you want to serve a default notice, you've got to serve it at this address. Of course, you go to the address, but it's lockdown, there's no one there. So how do you go about serving a notice? So all these then interesting questions come up about, actually, are there alternative methods of serving notices? And that's led to all sorts of other industry kind of projects to make that easier. So that was that in the kind of immediate onset of the pandemic. There were a lot of new issues to deal with. And then in terms of your question around products, what we then see is, particularly as the interest rates go up, if you're looking at investment funds, for example, or large superannuation funds, pension funds, what are they doing? They're trying to generate a return that is higher than the base rate of interest, because otherwise you just put your money on deposit. So they then have to think, well, how do I go and generate returns? And so what we then saw is people moving into different asset classes. And I'm not, I haven't got an economics background, so I kind of observed it just by virtue of what clients were talking to me about. And then I heard some economists say something, and I think, oh, it all makes sense, which is commodities. People just went nuts for commodities, actually, because that's where they thought that they could generate the extra yield. And so again, we just out of the blue, we saw an uptick in people doing kind of structured commodity derivatives. And then the other thing that we saw, and I think Nick, you mentioned it as well, is people then at the same time trying to manage their cost base. And so when you're a bank, one of the largest, apart from your IT bill, one of your largest cost bases is regulatory capital, and both of you have talked about this, that we then saw an uptick in people using credit derivatives to try and release regulatory capital because they saw that as a kind of cost base that they could try and reduce. So that's kind of what we saw over those few years, which is quite interesting.
That was very interesting. Thank you, Deepak, for sharing that with us. I'm just going to move back to Ed. I think we might run over time a little bit because we started a little bit late, and I do need to get back to Nick with a couple of questions as well, because he's flown all the way over from New York to talk to us all today. So it was very kind of him to join us. So Ed, how have derivative practices and the work they do for clients changed in your time since you left the University of Law?
Well, as I mentioned earlier, I left the University of Law in 1996, having done the LPC. I'd first heard of derivatives the year before. I was doing an LLM, and a partner from Mayer Brown and Platt, as it then was, came in and talked about derivatives. And I always joke when I talk to our trainees, I should have said, I'll have your job one day, and you guys will probably say that and do that to me at some point. But I mention that because at that point I remember him talking about negotiating these ISDA master agreements that were then, in their infancy, the 1992 master agreement. This would be something that our equivalents, I would have negotiated the ISDA master agreement against Deepak, and that has moved now that there will be people like DRS who will have a big centre in Newcastle and teams of people doing that at a very junior level. So we've seen things move away from the law firms in terms of doing that sort of work. I then trained, like you, at Clifford Chance, although we didn't know each other. But back then, there was a lot of repackaging work which had integrated derivatives within it. And I rode this wave as I qualified, as these things became synthetic CDOs, and we saw all these really, truly complex products like CDO squareds and cubes that were referencing portfolios of credit derivatives. It's interesting that that Deepak mentions delivering notices. There was we picked up a big instruction of managing all the credit events that happened, and for one of these CDO cubes, because these were notional portfolios, I had to stand over a fax machine and send a fax to ourselves back again to trigger these trigger these credit events. So things had got really crazy, and then they blew up. And it moved completely from drafting these highly complex transactions to managing them, to managing the closeout, to recovering money. I worked for 8 years on the Lehman insolvency for KPMG as the administrator of Lehman Asia. The month after Lehman went bust was the busiest of my career. The phone didn't stop ringing. And so we went through this whole long process of working out derivatives, working out the closeout. Derivatives, when the crisis happened, I remember my parents calling me up and saying, "I've been watching the news. This is what you do, isn't it? It's your fault, all this derivatives." And you had things like the regulators really wanted to put these punitive regulations in place. So they were announced about 2011, 2012. We spent a long time advising clients, what are these regulations going to be? And then putting these in place. So we spoke for years doing these whole collateral agreements that are highly complex, of putting all the regulatory environment in place. And then we've seen new asset classes come through in the last few years, crypto that's mentioned, ESG derivatives as well. And what's really keeping us busy is that as a consequence of the financial crisis, capital requirements for banks are much tighter, and derivatives being driven by ways of reallocating capital risks to insurers, to other investors, to private equity and similar. So it really has changed over that period. There are some similarities, some things that don't change, but I think every 2 or 3 years it's been very different. And what we were doing with initial margin, which was was 6 years of work of what were the rules, putting all of this in place globally. That's done and dusted. Then we had LIBOR transition. How do we transition all the LIBOR rates? That was 2 years of intensive work. that is finished, we've now got the new Basel IV regulations coming into place. That's going to be driving things as well. So there are different themes that come through, and this isn't the end. If we have this talk in a few years' time, there'll be something entirely new that's come through.
So back to the point that derivatives are fun and exciting. So Ed, my final question for you, moving from an overview of the entirety of your career to the present, what impact do you think the current change of leadership in the United Kingdom could have with the move from Conservative Party to the Labour Party on the derivatives market?
Well, the big thing is going to be divergence with the EU, and it's very difficult to say what that difference will be. So when we have sort of Brexit Day, we have all the EU regulations that are implemented into UK law. So I think what we're going to see is, to what extent are we going to see divergence with the EU? I think that from what we're seeing being said, we're less likely to see a divergence as we would have with a continued Conservative government. But there will be things such as, we mentioned ESG, emissions allowances are different now in the UK to the EU. There will be a continuing difference on that front. I see that being one of the main pieces. The same will be how's the regulatory environment going to go as well. Deepak mentioned bankers' bonus caps maybe disappearing, or maybe not as well. It's early days to say it, but those are the sort of things that will make a difference. What will drive institutions back towards the UK? To what extent will we see divergence with the EU, with laws as they're implemented?
Brilliant, thank you, Ed, that's very helpful. And on that same subject, just moving over to you, Nick, as I mentioned, we are going to go over time a little bit, and then we'll move into Q&A with the audience. I hope you're all still comfortable with that. I've just got a few questions for Nick. On that point of current changes of political parties, moving over to look at the United States, if you do see a change of leadership in the US at the next general election, could we expect to see any impact on the degree of regulation of the market? Do you think a change of leadership may lead to a more regulated or a less regulated market from a US perspective?
Yeah, it's a great question. I'll try not to do the American thing and just assume that everybody understands all the workings of our system. A lot of the rules regulations, laws that govern this space are done at the agency level. Our equivalent of the FCA, the SEC, which deals with securities, and the CFTC, which deals with commodities and futures. And there's a lot of overlap between the two. But it's mainly done through an administrative rulemaking process. And the way those generally work is each agency will have 5 commissioners. And if there's a Democratic president in office, then 3 of those commissioners will be Democratic. If there's a Republican president in office, 3 of those commissioners will be Republican. And so those agencies have, other than some, at least up until this most recent Supreme Court term, those agencies had a lot of discretion and a pretty broad mandate in terms of how they can adopt rules, implement rules, etc. Historically, you could assume that Republicans were going to try to deregulate and that Democrats were going to try to add regulation. Certainly, I think these last 3.5 years or so with this guy Gary Gensler, who's the head of the SEC now, it's been one of the more active rulemakings. Gone after some huge high-ticket areas. The most recent is Treasuries, which is the deepest, most liquid market in any financial asset in the world, and there's a fundamental overhaul in the way of requiring clearing for a lot of the Treasury transactions that's in the process. It's been adopted, it's in the process of being implemented. So there's certainly been huge change.
So in fact, that goes back to your early question about things that are on the horizon.
Exactly. And, but I think this latest iteration of the Republican Party is really sort of more of an asterisk. Under the first Donald Trump presidency, for instance, this is not derivative related, but there's these huge asset managers like BlackRock, and most of their investments are passive, and they don't, retail investors technically can vote their shares, but nobody's actually voting. So these firms like BlackRock get these, proxy voting advisory firms to say, like, hey, here's how we think you should vote on this particular issue that this company is raising at its next, board meeting. And, what we saw under the first Donald Trump presidency was the SEC at the time, instead, in a move basically that was more favorable to companies, added regulations to restrict the ability of those companies to give advice and restrict the ability of the asset managers to rely on the advice. And then fast forward, this new commission under Biden loosened those rules, and so we just sort of went back and forth. So, all that to say, I think there certainly would be change, but honestly, it's a bit up in the air as to whether it would actually mean less or just different, regulations.
Just a couple of questions about what you've just discussed. Firstly, you mentioned Gary Gensler. Do you think that a change of government could lead to, would he stay in his role?
No, he would go.
So he would automatically go. Oh,
yep.
That's interesting. And the other question I had was, you just mentioned the recent Supreme Court decision, which will change that mechanism that you just described. Could you tell us a little bit about that recent Supreme Court decision, which I believe is Chevron? Is that?
Yeah, so there's actually been 4. What we've seen kind of going back to 2016 is a gradual erosion of the ability of these regulatory agencies, not just the ones that do securities, but things like the Environmental Protection Agency, Department of Labor, a whole bunch of others. Like a slow erosion by the Supreme Court. So generally speaking, right, Congress is not subject matter experts. The legislators don't know the ins and outs. So a lot of times they have pretty broad statutes that say, like, hey, we want you to handle this, or SEC, we want you to mandate necessary and material disclosures in securities offerings, and then it's up to the SEC to figure out what necessary and material disclosure might mean. So there was this case Chevron in 1984 involving Chevron, and basically Chevron was challenging something by the EPA that said, you can't pollute this much, and the court said, look, this is a highly scientific thing. The legislative act that gave them this power is called the Clean Air Act. The goal of it is, they can put in rules to help us get cleaner air. So we're just going to trust that they did their research, they followed all the proper rulemaking procedures, and throughout the case against Chevron. So the takeaway from that case was that if a congressional mandate to a regulatory agency is ambiguous, unclear, or there's gaps, as long as it's reasonable and the administrative procedures were followed, courts would defer to those agencies. So the first case that came up was in 2016, and the court invented this thing called the major case doctrine. And what that basically said is, yes, in general, if a statute is ambiguous or there's gaps, we'll defer to the agency, unless it implicates a major question. And a major question, could be something like, nothing in the Securities Act of 1933 or the Exchange Act of 1934 talks about ESG, talks about cybersecurity, or talks about crypto. So it's a major question, potentially, whether the SEC could actually pass any rules regulating ESG disclosures, ESG products, cybersecurity protocols, or rules around the digital asset space. So that was kind of the first strike. Then there was this most recent case, which officially threw out the Chevron doctrine and basically said, essentially any rule can be challenged. It can come before the court, and we, the court, will figure out whether the rule should have been passed, whether it's okay, or whether they should have done something different. And kind of took that, what had been deference, and instead now made it a judiciary discretional decision. And then the last, well, there's one other, but the last big case I'll talk about in the interest of time was much less understated, and for this one I will say the facts, because I think it's a bit ridiculous that this is the case that kind of fundamentally overchanged. There's an interest in having settled law, right? Everyone agreeing that these are the rules. After some point in time, rules can't be challenged, right? There's a statute of limitations. And everybody, for basically as long as all these executive agencies had been in place, assumed that the statute of limitations, which was 6 years, started running when an agency passed a rule. So a rule gets passed by the Federal Reserve in 2011. If nobody challenges it by 2017, then that's the settled law of the land. End of story. Tough luck if you wanted to challenge it a few years later. So what this last case did there was a truck stop in North Dakota that was incorporated in 2018. And way earlier in 2011, the Federal Reserve had passed a cap on the amount of debit card interchange fees that certain that banks can charge. And on the flip side, that institutions like truck stops in North Dakota have to pay. And so trial court said it's dismissed. The rule was finalized in 2011. It's 2018. That's more than 6 years. Tough luck. The Circuit Court of Appeals confirmed that decision, and then it got to the Supreme Court, and the Supreme Court actually said, no, your injuries the statute of limitations don't start running until an individual entity person is affected by the rule. So this company was incorporated in 2018, therefore it couldn't have challenged the rule in 6 years prior, and so they have 6 years from when they incorporated 2018 to challenge the rule. So when you kind of take those two things together, what it means is that we're not going to defer to these agencies. Any rule can be challenged by the court, and with that decision, literally every rule is now challengeable. And so there's it's all in the last month, so the actual impact is yet to be seen. But one thing that, at least initially, folks think is going to happen is a lot more emphasis on kind of regulation by enforcement. We didn't technically make a rule, we just punished one person for doing one thing, and so hopefully everybody else will see that and decide they don't want to do that. But there was one other case that I won't get into that it put a constraint on certain of the regulatory agencies' abilities to bring certain enforcement actions through kind of a process other than trial, which Congress had authorized them to do. So even their ability to regulate by enforcement is also kind of up in the air now based on one of these latest decisions.
Thank you, Nick, for giving us that insight into the US and the way the legal system works. It was very interesting. I just want to bring us back to kind of a more global point again with regard to derivatives and the way that derivatives as a market. Throughout this conversation today and the discussion we've been looking at different the impact of different events really on this market throughout the last, 20, 30 years, although Ed's discussion may have gone back really just a few years maybe. But effectively, my last question is with regard to stress events. What do you think the derivative market's ability is to handle various different types of stress events? And I'd like you to discuss in particular one case from America, which was very predictable, Archegos, and one case in the UK quite recently in 22, the November, I don't know if anyone in the audience recalls this, it was all over the press, the gilts drama, UK gilt crisis with the yields, UK gilt yields spike. So Nick, could you talk about those two events and whether you feel the derivatives market has the ability to take the impact of this kind of volatility?
Yeah, definitely. So as Deepak had said, a lot of the goals of most of the regulations that have come out after the global financial crisis have been focused on, reporting. So let's call that transparency. Having a better sense of how deep this market is and where certain exposures might lie. And another big goal was in reducing the risk, specifically counterparty risk, right? So that whole variation margin thing that everyone has talked about. What that does is it reduces the likelihood that if Rebecca owes me money under a derivative, if she's posting incremental amounts every day, barring a huge one-day swing, even if she does default, my loss is probably going to be pretty limited because most of her collateral, most of what she owed me would have already been posted in the form of collateral. And so the regulations have certainly succeeded in that. They've also, a bit TBD, but at least increased transparency. So Archegos, as you said, was sort of predictable, and it came up for a few issues. One, but I'll set this aside, is just there was outright fraud involved. The founder, there was this family office. He was a former successful hedge fund person, like one of the Tiger Cubs, and created a family office and then out of nowhere had a net worth of 36 billion and nobody had ever heard of him. The reason everyone had finally heard of him is that he had basically piled into a very small number of stocks, hugely leveraged positions with essentially every bank across the street. And so when they all started deciding that, oh, this entity can't pay, we need to start selling these off, they all drove the price down, and I think all in, when it was all the dust settled, over 20 billion in losses collectively to the various banks. But so the point of that is that was sort of a gap in the regulation that there is in the U.S. security-based swap rules that require reporting of those types of transactions, but it's all anonymized. It's not, you can't look at it and see that, hey, this particular family's office position is notional exposure to 50% of this small company's market cap. So they're basically not controlling the price movements. So one of the rules that's been proposed but not yet enacted would increase reporting requirements specifically for people who have a large position in a single name, so that not only do you have the anonymous kind of generic bird's eye view of the market data, but you could also drill down to see that there might be an issue with this particular stock because this person's exposure is a disproportionate amount of the market cap. So that one falls into kind of the more predictable bucket. Again, setting aside the fraud, because these banks were asking questions and in theory thought that the family office could meet these demands because it just lied about what it held. It said, oh, we have a bunch of Amazon and Apple, all the safe stuff, don't even worry. But they didn't. They just had more of the same, in those small companies. I think the other part, and I'll keep my explanation on this one shorter so you guys can jump in, with the gilt crisis, there's always the law of unintended consequences, right? And I think there's, a couple things involved. One is that there was, I think going back to 1990, there had never been a 100 basis point swing in the yield on gilts, and within 3 days, I think it was 140 basis points. So it was a wild swing that, all the different models and stress tests that everyone, from the government regulators to the market participants, nobody was stress testing this wild scenario. So that's kind of point one. But point two is there's, a lot of these gilt, there's an increase in the collateral that needs to be posted, and a lot of collateral is very safe. It's usually cash or, in the U.S. Treasuries, here gilt, and there's these now very strict margin requirements, and so as interest rates spike, the price of these gilts goes down. So now, even if nobody actually thinks there's going to be a default in the payment of the gilts, and that realistically it's still worth $100 plus, or face amount plus accrued interest, they have to require more margin. So more gilts either have to be posted or liquidated so that cash can be deposited, because cash wouldn't have the haircut. So just as you have this downward pressure on the price, that gets accelerated because now you have people trying to sell and monetize their assets. And it goes back to some of the tech points and operational considerations that I talked about earlier, where if you essentially have all these different siloed pots of collateral all over the place, and if there is a more efficient way where the collateral from over here can get put over here right when it needs it, so there's not, you can avoid mismatches in the timing of payments over here versus the timing of requiring to post margin over here. I think those are certainly things that now have been revealed at least to some extent, and the market is working to address.
Yeah, and the Bank of England stepped in and helped remediate that problem, as I recall. I think that brings us nicely to the end of our discussion time. Can we open this up for a quick Q&A before we have our networking and drinks and canapes? I hope that everyone's not really hungry and can wait another 10 or 15 minutes. I think we have Karen and Ryan, who are roving mics for anybody with any questions for our panel.
Some payments are required in this jurisdiction that could be had from another. Would that not lead to the contagion risk And would regulators not try to avoid that? If there's pressure on one jurisdiction.
Sorry, could you just repeat the question now you've got the mic?
Sorry. I'll go back to the last point that we were discussing that Mick elaborated on. If there's a requirement in one jurisdiction, there's pressure, selling pressure, that you could settle with having resources from another jurisdiction, would that not lead to a contagion risk, something that regulators always try to avoid?
So, there is the law of unintended consequences, so certainly would never say never. I think the thought would be that, rather than having to immediately sell off, some assets so that you can meet your margin call here, if you already had, maybe gilts or maybe something else, over in this other place that you could monetize without either by transferring or, some sort of securities finance transaction, but some way to monetize that without having to liquidate, then the decrease in everyone trying to liquidate would help to ease some of the, in this case, downward price pressure that the necessity to meet margin calls caused.
Thank you.
Thank you all for the presentation. My question is, given the current geopolitical issues and the use of sanctions, how do you think that would affect global clients when they're discussing derivatives and contracts?
Well, I might jump in there. The sanctions issue was a really big one, with sanctions being placed particularly on Russia over Ukraine. And one that we do have in the standard documents ways to deal with that. So we have in the ISDA agreement, we have an illegality termination event, but clients would needed advice because it's not as simple as if there are sanctions on Russia, what does that mean? Does that affect an entity that's a German entity and it's owned through an entity in Cyprus, which is in turn owned by sanctioned individuals in Russia? So there was a huge appetite for advice in relation to sanctions generally, which were sanctioned entities, and then what was the effect of delivering this illegality termination event. But then one of the effects of that is if you were the party that had to declare that illegality termination event because you could no longer trade with an entity in Russia, it would be that Russian entity that had to, or that also you'd be looking at closeout payments that would have to be made. Could you make those closeout payments? Because now you couldn't transfer any money to that entity either. So there are all sorts of complexities around that, and it's not just UK sanctions. You've got EU sanctions, you've got US sanctions as well, and the consequences of getting it wrong are horrific. If you look at some of the fines that are put in place for dealing with Iran, for example, contrary to Iranian sanctions, you're looking at hundreds of millions of dollars being placed in fines, and the US has a massive extraterritorial reach. So just by using the US dollar system, you can be brought into that effect. So absolutely, it will go through waves of activity. So something happens on a geopolitical level, sanctions are put in place, then you need to have good sanctions advice, and you would have a lot of appetite from your global clients, because the consequence of making a mistake can not only be massive financially, they can also be criminal as well.
Thank you very much for a really interesting discussion. My question is related to governance and the ongoing litigation in interest rate swaps, which has started back in Hazel. Now we're in the last vestiges of litigation in Italian municipals in particular. Mm-hmm. There was an interesting case with the municipality of Venice, in which the High Court ruled in favor of the idea that when the municipality entered the swap, interest rate swap, which was a very interesting one, just to contextualize, it was it's a municipality that gets revenue in euro, and they swapped the floating rate euro into a dollar fixed rate, which doesn't really make a lot of sense. So the fundamental question was, the Italian Supreme Court ruled in Italy several years ago, and they basically said that municipalities are not allowed to speculate.
Yep.
They're not allowed to increase their debt. And Lord Justice Foxton was the High Court judge that sort of ruled in favour of the interpretation of the swaps being speculative and increasing debt because of the mark-to-market mechanism. And my question is that the Justice Phlox, who was the Court of Appeal justice, basically said, I'm going to look back to the original swap, which came from Bear Stearns. It was novated into a new swap. And what he said is, because I see that that swap was defined as a hedge, it is a hedge. He didn't get into the fact that there is a basis risk because I'm going into essentially a currency swap on top of an interest rate swap for an entity that has no business. I mean, I'm a local authority, what's it doing sort of borrowing in dollars, essentially, if its revenues are all in euro? So my question is, this is a very fundamental disparity between English law and the law of a European country. And what do you think? What do you think the consequences of this are in terms of the stability of the law in this area?
Well, you've got two, Deepa, I'll let you jump in as well, but you've got two elements that you raised there. So the contract would have been under English law, so you would have had an English law judge interpreting that contract. But part of that would be that the entity entering into that contract must have had capacity to do so, which would have been, in the example you gave, judged by the Italian court. And this is where it becomes quite complex, because you will have a divergence between the two. You're more likely to get a ruling, perhaps in Italy, that a local authority has lost money and therefore it was this awful foreign bank that offered this contract, therefore they should not have to pay that amount. And you used that example of Hazel from many years ago, where Hammersmith Council had entered into massive swaps, and what happened? The courts decided, actually that was ultra vires, they shouldn't have entered into that. So the consequence years later is there's a lot more focus on getting legal opinions that indeed there is the proper capacity to enter into those contracts. But you are often, and this is the global point, you are going to get those tensions between the legal systems. They are not always going to match. We worked on a very big case that involved UBS, which had entered into credit derivatives with the Leipzig Water Authority. This ran from aspects of that, went all the way up to the Supreme Court. But one of the first battles was, should this be in front of the German courts? Should it be in front of the UK courts? And the first win for the bank was actually to get that in front of the courts, the English courts. But I think you will always get that tension. There's no easy answer to that, other than I think the governance, and your question started with the governance. The governance is much stronger now. When we were talking about years before the financial crisis, it was quite light. There were very few people doing the regulatory element. That's a major part of the institutions now. You would not see those swaps being entered into today, but yes, it's been huge, the litigation that's flown for years.
I agree, and regulators have basically woken up, dare I say, to some of the risks where people don't have that governance, and so I've been proactively interrogating the legal due diligence that banks in particular undertake. So that's not only around capacity, but also if your counterparty becomes insolvent, do you know whether your contract will work, i.e. closeout netting will work? So I think the issue, people are much more alive to the issue nowadays. Simon Martin, I work for London Stock Exchange Group. 2 questions. Number 1, is there a future
in open outcry floor trading? Second question, thank you for a fascinating discussion. Where should anybody who is an alumnus of the College of Law with a professional background in derivatives go looking for a job in London, New York, or elsewhere?
I'll take the easy one on the open outcry trading. It used to be that whenever you saw the news, it made great theatre, and they'd show all these people in blazers, and they'd be shouting about the prices. And actually, what you wouldn't see so much, was there would be people at computer screens at the edge of the open outcry trading floor that were running all of these systems. And I think there's only one. Is it the oil, or one of the oil ones? That is the only one that is left as open outcry. And unfortunately, I think it's gone. Everything's, and we comment on the technology. It's the technology that's pushed us through, the sheer volume of millions of trades. And when we see the figures that come through from ISDA of the trillions and trillions of dollars that are done through interest rate swaps and other areas, they're centrally cleared, they're on standardized contracts. It's a shame that open outcry has gone, because it looked like an absolutely wonderful theatre. I never had the privilege of going and watching that live. So that's unfortunately is gone. It's a bit like the Hammurabi Code and other pieces. It's a piece of our past. But I'll pass the finding a job to Deepak.
I was going to take the easier question, which was to say no, there's no future in it. So on the job question, I have no idea. Actually, it's a tough market, I would say. Actually, I do think in the derivatives market nowadays that actually a number of points that we've touched on kind of feed into this. So one, the kind of increased regulation means that actually for some people there's less merit in using derivatives as a hedging tool, and I think and part of it is the onset of technology, because a lot of the time, as you were saying, Ed, we would sit and negotiate contracts for days, which now pretty much get done in minutes. So I think that is part of the evolution of the industry. So I haven't quite answered the question, but that was me.
But actually, I think where the jobs lie, a lot of it is on the regulatory, the regulatory side, the enforcement, and the technology side as well. I believe there's about 10,000 people who are employed in derivatives in London, and if you divided that up, it would be a huge amount on that tech side, compliance, all of that bit to putting it together. And we're just a small handful of private practice lawyers.
I'll finish it up just to say in the US, the open outcry is officially done. There was always a fear that they were sort of the market makers of last resort, but COVID necessitated not having them for a time, and the world didn't end, so open outcry did. On the job front, one thing, I think alumni networks are great, at least in the US. One of the features on all the law firm websites is by searching by law school. And when I was first starting out, I would just email, I'd look to find folks, that just went to St. John's, ideally that went to St. John's, that did something in the security finance space, and just reach out like, hey, I would love to chat, just hear more about your job. And people love to talk about themselves, so you get a surprisingly high hit rate. And it's only gotten easier now, obviously, with everyone knowing how to use Zoom and Teams and WebEx and all of that.
I know you've all been sitting here for 1 hour, 43 minutes now, listening to this fascinating subject. I think we've got time for just one more question, and then I'm going to suggest everyone goes to grab food and drinks. We have the last question. Thank you.
My name is Adnan. I'm an LLM student at Queen Mary, and I've worked in Islamic finance for 2 years. So my question is about Islamic derivatives. I wanted to know if you could just give us a brief account of how you've helped Islamic banks and Islamic financial institutions hedge their risks in a Sharia-compliant way. And also, have we seen a take-up of certain agreements like ISDA/IFM Better Howard agreement in some jurisdictions, for example, like Malaysia or the Middle East?
Well, I also did an LLM at Queen Mary. It was a fascinating year, actually, really sort of broadened my horizons. There is what are the issues with Islamic finance and derivatives? One of the main ones is interest rates, which do not fit with Islamic finance. Another element is speculation as well. So there is an Islamic finance is the master agreement, and derivatives are used with Islamic finance structures. We, as a global law firm, we do have a presence in Dubai, but it's not a particularly large one. And most of the Islamic there are, of course, the Malaysian Islamic finance derivatives, but it's a bigger market in the Middle East generally. But I think it's using and adapting European structures that then can fit into the Islamic finance piece and be blessed or approved by Islamic scholars. But there's huge pools of capital that are sitting there. There are deals. I think Linklaters, you've done more of those than we have.
Yeah, on the usage, we are seeing more and more actually, and it's a really hot topic at the moment. So both on kind of how I would consider a product to be an interest rate or an FX product. And we are also seeing more traditional Islamic finance kind of lending, so murabahas, and then the associated profit rate swap that sits alongside. So that is something that we, and it's quite interesting in terms of the kind of market users. So you're right. So Malaysia as well, we are seeing in our Singapore and Hong Kong offices a kind of uptick, and equally out of London and Dubai and Riyadh, we're seeing an uptick. And what we're also noticing is actually a lot of business is heading in that direction, and so that means that as part of the armory, if you like, in terms of what banks and investment firms are offering clients in the region, it's not only traditional finance but also Islamic finance. So yeah, very topical actually.
Thank you, Deepak. Thank you very much. Before we all go and enjoy the networking and have some drinks and some canapes next door, which I do hope you'll all stay for, we are being kicked out by Linklaters at 9:30, so please take full advantage until that time. Could you join me, please, in giving Ed, Deepak, and Nick a huge round of applause?
And Rebecca as well.
So I've just got to wait because I've got something for you.
Oh no, you really don't need to do that.
That is very good.